Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld, PSW, nor its affiliates, nor any of the respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. Isn't that good to know? All right. So what's going on? Sri says she's a cheapy subscriber. Uh-oh. Might not get a chance to wish you tomorrow. Okay, fine. Well, I'll accept it then. Well, you know, for my birthday, you could get like a premium subscription. See? All right. So where are we? Oh, wow. Ugly. Wow, look at this. Jeez. We were just up at 24.80, and now we're at 23.8. Wait, 23. No, it was 24. It's like 200 points in 45 minutes. That's crazy. Wow, this market is insane. All right. Well, what can you say? Unfortunately, I was hoping to. Gosh, my plan was to tell you where it was good to short the market. I don't know what to do now. I have no plan. I was not accounting for this. This morning I was saying I thought we were going to fail, and we failed. You know, we did. This morning we failed. You know what I said, because I said that I thought the thing was going to go down, and then we came back for no good reason, as usual, and that made it a good time to short again. But I didn't have a chance to put the play on. What were we saying this morning? I forgot. This is a PSW member chat. Let's see. I said wait for NQ to fail 6,500 and ES 2,600 before shorting again. That was our plan for the day. So I'm not sure where we are now. Are we there? There's 6,500, so just failed, and 2,600 hasn't actually failed yet. So it's still not so bad. You know, these are the lines we were watching this morning. And then I said, what did I say after that, though? I know I said something different. Oil did exactly what we thought. Oil had a much better draw than they thought it would be net. We'll take a look at that report in a minute. It's still, you know, generally, it doesn't change anything, but at least they had a draw in gasoline, a draw in distillates. But that's only because we're exporting so much of it. That's where the draw is coming from. It's not because, and see, oil is up. It's not because we need it. It's because we're exporting it. We're just acting as refiners for other countries. So it doesn't, and people are interpreting that on purpose, misinterpreting that as demand in the U.S. It's obviously not demand in the U.S. We're acting as a refiner for other people. The fact that we're refining more oil that we then send overseas doesn't make it a demand thing in America. The only demand is from the refineries. So what else we got? Tesla, Netflix, Sonic. We talked about Tesla being totally screwed. Talks about me getting old. Let's see. Oil rejected. I don't know. We were talking about, anyway, the point was that I said in general, I know what I would say. It's Control F window. Oh, I said in the post. That's why. I said this morning we're testing 65.50 again on the NASDAQ. If that fails to hold, it's a good short play with stops above that line. Usually into the end of the quarter, we get some window dressing as the funds try to pretty up their books. But this quarter is already a disaster, and they would probably rather force a lower close on Thursday so they can get a better rebound in Q2. So expect more downside from here. So that was when we were at 65.50 in the morning. I knew that other one didn't sound right. So here at 65.50 on the NASDAQ, which is right here, is where I was talking about that this morning, and then we retested it here, so it became the same good short again. So now really your stop would be, obviously, if it comes back to 6,500, then we would stop. But if it tries 6,500 and fails, that becomes a good shorting line too. But meanwhile, there's no, as far as I know, there's no rhyme or reason for this. This is all just funds squaring up their books one way or the other into the close of the quarter. It's not, there's no particular reason that it's doing this. And on the whole, we're probably going to kind of flatline around this line, but I think a little push down at the end of the day tomorrow. I think there'll be a bit of selling into the close. All right. So I was hoping to have a good trade thing for the futures to play with, but right now I don't really see a particularly good setup there. Let's look at the other charts and see how they look. In case I'm missing something. Well, we have oil bouncing around 64. We have gasoline that bounced off the $2. That would have been a good long. Gasoline bouncing off the $2 line is kind of obvious. Natural gas is starting to fall a bit. The Nikkei, wow, the Nikkei's been, because of the strong dollar. The dollar has been blazing higher, which hurts the markets, by the way. But the dollar's been blazing higher, and that's helped the Nikkei. But now, if the indexes are falling, the Nikkei is a great trailing short because it's still way up there. It's up 400 points today, and meanwhile the Dow is heading down. So that makes the Nikkei a very interesting short there. We hardly ever played the Nikkei, so that's kind of fun. Gold is down. Silver, I like silver long down here at 25. But that's a longer term play. But I certainly like playing silver long at 1625. The dollar puts pressure on everything. I mean, anything that's priced in dollars. If the dollar goes up, then you need less dollars to buy the thing that's priced in dollars. Okay, you get that? That's what the relative value of the dollar is. So especially for commodities, which are globally traded, things that are globally traded, like stocks and commodities and bonds, if they're globally traded and the dollar is one of the currencies something is trading in, then when the dollar gets stronger, you need less dollars to buy the thing that you're buying, to buy the commodity or the equity or whatever. So it has a direct short-term effect, but that effect fades very, very quickly. It's interesting because it fades over the midterm, but then over the longer term, it sort of reasserts itself. So when you do long-term dollar graph comparisons, you can see the dollar's effect on like an index or a commodity over long periods of time. On a daily, there's almost a direct inverse correlation between the dollar and the commodity or something. But over a week or a month, other factors tend to affect things much more so than the price of the dollar. So it just becomes one of the things affecting a commodity, but not the thing affecting a commodity. But in the dailies, it's practically the thing, unless some specific news happens. The dollar is the thing that affects the commodities. And they have a very inverse relationship to that. I mean, today, for example, you had the oil inventories. That had a bigger effect on the dollar, so that washed it out. But anyway, so silver, here's a dollar. These things are on the same time frame. So here's a dollar at its low. Here's silver at its high. Here's the dollar at its high. Here's silver at its low. This is not a complicated thing to follow. In fact, you can see it's like it goes up and he goes down, and then he bounces and he bounces, and then he heads back up and he heads back down. It's very simple. So meanwhile, we're going to get rejected at 90, okay, and maybe not a big rejection, but now. So now you got to think at 90. You have to say, well, okay, why is the dollar getting stronger? Because Europe is shaky, and the trade talks and all that stuff going on, and the Brexit thing is a big scandal now. Because it turns out that the same guys who got Trump elected with the data, Cambridge Analytica, they also were on the Brexit thing. They were basically pushing that to get Britain out of the EU. So now people are starting to question the whole concept of what the hell they're doing. But anyway, long term, I like silver anyhow. I don't mind buying more if it goes lower, but it's very expensive if it moves against you. 25 cents in silver is like $1,250. It's like $50 a penny. So not one you want to mess around with too much, but let's take one just to say it's an official webinar play. So we'll say silver, SI, and I'm not messing around. I'm going to just take this one here at 26. I'd like to get 25. Let's see what the dollar looks like. If the dollar doesn't look like it's going any lower, then I'm not going to bet silver. I'm not sorry. If the dollar doesn't look like it's going to make 50, then I may as well buy silver, right? So, well, let's flip the baby here. I'll take 25.5 if we can get it. Ooh, that was way too easy. I shorted it. Oh my God, no wonder it was easy. Oh, I hit the wrong side. Try it, see if we can buy it back. Damn it. That was not smart. The only good thing is there are more people. There were more people on that side than my side. Oh, that's what I'm telling you guys what I'm doing. Okay, wait for me to get out of mine before you start buying, please. Okay. I messed up. I'm really pissed. Oh, come on. Don't do me like that, baby. The good news is the dollar. There we go. Okay, so I got out, and now I want to get in. But I'm going to wait because the dollar is going up, and that might hopefully get me down to 250. See, so I'm flat, and all I lost was the money I paid for the in and out on the trade there, which is about, I think, $350 a contract, something like that. Maybe $150 a contract. I don't know. Not much. So being greedy, but want to see hitting 48 here. So I'm watching the dollar. The dollar has pressure up. 25 people buying, 24 selling. Now it's 22 and 11. That's not good. So that's coming the other way. So I may be forced to buy here. Oh, I guess I am. All right. Well, now I'm going to have to buy at the same spot I want. Nope, now I'm in. All right. So now I'm in at the spot I wanted to be in at, except I didn't really want to. I want to be this much lower, but it doesn't matter. Ah, now I could have maybe filled it. All right. Anyway, it's a long-term trade. So like I said, it's not really important now. If it goes down to 16, probably around 16.05, I'd buy another one, because at 16.05, my average would be 16.15. So I'd have two at 16.15. That's where I'd want to be. So if it drops down to 16, then I will add another one at 16.15 is my plan. All right, but that would probably take the dollar breaking over 89.50. I do think the dollar can hit 90. The dollar could hit 90, and then silver might be down about 16, and I'd have to add some there. All right, but that would be my play at the moment. AG says, when to take off or roll the May SQQ spread, how to handle or roll hedges like this in general. We don't take it off or roll it. It's insurance, okay? So you're buying an insurance policy for the SQQ. It says, I don't know what it says on the short-term portfolio. Let me see. Well, May. Oh, you mean the one from the Post. I know, you mean the one from yesterday. Not Wednesday. This one. Did I put it up yesterday? No, it was. We should talk about those trades. All right, Monday. Okay, so the May one is here. We were talking about selling some IMAX puts to pay for the spread. Why do we sell the IMAX puts? We sell the IMAX puts because I look at things, I look at my wish list, my watch list. I look at my watch list and I say, and watch list is, by the way, it's not hard to find. It's right. Wait, it would be, you guys can't see this, but there's a big comment screen here. Okay. Under our portfolio tab, we have a watch list. And I just go through my watch list, and these are dynamic charts. They change all the time. And I say, well, who's still cheap? So I say, oh, ABX is still cheap. ALK is still cheap. Oh, I love them too. I always want to sell puts on ALK. We've already double sold ALK for puts. Best Buy is still cheap. Boston Property, not Blackstone's still cheap. Cheesecake got away. CBI got away. Hang on, I gotta make this thing smaller. It's too annoying. Okay. CDE looks like, oh, it's going to a nice triangle squeezy thing. I think that's going to pop. CHK, who just said they are not in financial trouble, but nobody believes them. CIM, CLF is still cheap. ETE still cheap. Ford still cheap. FNSR, wait, what the frick with this thing? Jeez. FTR coming off the floor a little bit. GCI still cheap. GE super cheap still. Gilead, Gilead, nice price. That's one I think I might want to sell some puts on. GNC is still cheap, consolidating. GoPro still very cheap. HRB unfortunately took a big bath. They were way up and hitting our zone. They fell way down again. But that's a good chance to pick them up again, actually. IMAX still ridiculously cheap. Well, that's one we did. LB, limited brand, still love them, and they're super cheap. Macy's got away. NOI still cheap. PSA got away. SKT getting away. SunPower coming back. Love them at this price. Target, nah, they got too high. THC, boom. Now they seem to be topping out here though, so we gotta maybe want to consider taking that off the table. WPM also kind of moving up. Whirlpool really crushed. Oh, wow, that's a great price down here. That's another good one. Anyway, so we looked for things that we could buy, and about half of these things are still cheap. And that's where we came up with IMAX, because I felt good about IMAX as a short-termer to do us good. Now, then SQQ, we take this hedge. This is an insurance play, though. SQQ is currently, I don't know what it is. SQQQ. The point of the spread is to protect us from a 10% or more drop in the S&P. It doesn't do anything when you have a 5% drop. Okay, it's like buying life insurance and you get knocked unconscious by a bicycle guy hits you in the street and you get knocked out on the pavement. You go to your life insurance company and you're like, okay, so can I collect now? And they're like, no, you're not dead. You were only knocked unconscious. That's not what this insurance is for. And just like that, I don't know why this is messing up like this. Just like that, this insurance is not going to protect you from a tiny little drop in the market. Okay? What we took was if I can find it, a 1722 spread. So the net of this spread was $1,350, and the most you can make on it is $10,000. The most you'll get back is $10,000. You get $2,000 for each dollar above 17. So obviously that works out. So where are we now? We are at 19. So right now it's worth $4,000 this spread. It's not going to be net. It's not going to show it's worth $4,000. But if the S&P stays where it is now, it's worth, you get $4,000 back. Okay, as I pointed out this morning, though, the thing's already up like $2,500. So you have to say to yourself, see this line? That probably, I mean, that's where we kind of stopped here as far as going down on the NASDAQ. But that's not really, you can't go by the ultra lines, even though it does kind of follow lines, similar lines on the NASDAQ. But in theory, it's kind of trying to break out to the upside here, which would be the NASDAQ going even lower. And in theory, the NASDAQ looks like it's breaking lower generally. Here's the NASDAQ pushing down. So this thing's getting stuck down in this range, and the SQQ stuck in its range. And if the NASDAQ breaks lower, SQQ will break higher. And then you really need your insurance. But as it is now, for this teeny little downturn, you don't need the insurance. So, you know, should you cash it out early and take a $2,000 profit? You know, it's not, I mean, then you don't have insurance. So what are you doing? Are you calling a bottom here? I wouldn't feel comfortable into a holiday saying I don't need insurance anymore. Oh boy, this got cheaper already, 1624. Oh, because he broke over 89.50, see? So probably ended up with getting two. And how are the actual, whoops. How are the indexes looking that good? All right. All right, good. So they're going back up again. We'll see what happens. Now, oil's right at 64. I'm just interested to see what happens there. That'll be interesting to see which rate goes. RB. Brent is at 68, and it failed 68.50. That's not a good sign. So unless Brent gets over 68.50, I wouldn't go long on oil. So no, nothing exciting there to play. Anyway, so let's see if I got the question right. So when to roll or handle, you know, so we don't take it off or roll it. If you think that you've had a really good drop and that it's done for, then you can maybe want to adjust it. But you got to play it by ear. It depends on the situation. 3 says, newbie question on the bull call spreads. Oh, we're back to SQQ again. 1620, is it, wait. Say 1620, ones we have, is it realistic to expect to get the full fall before the options expire? No, again, it's insurance, okay? It's a life insurance policy that says if the S&P, if the NASDAQ is down 10% in May from where it is now and stays down, not goes to, you know, it doesn't immediately pay you just because it goes down 10%. But if the NASDAQ is down about 10% or not even 10%, but roughly, then you will get paid $10,000. If the NASDAQ is not down 10%, you will not get $10,000. You're paying $1,350 for an insurance policy that covers you for $10,000 until May expiration. And what they're promising you is the NASDAQ will not be down 10% between now and then, or will pay you. But you understand, or will pay you. If the NASDAQ isn't down, you're not going to get paid, or you'll get paid less, or none, like somewhere between all and none, you'll get paid. But the higher the NASDAQ goes, the closer to none you're going to get. But that's all it is. It's insurance. You expect to lose it. Now, the problem I think most of you guys have is that you don't know for a fact, you don't set your positions up so that they will definitely pay you if the market is flat, or they will definitely pay you if the market is up. And that's a problem, because the whole concept of hedging is predicated on the idea that if you don't need the hedge, you're going to make money. I see too many people out there who have positions where they only make money if the market goes up. And that's not smart. Most of the positions we take will make money in a slightly down market, in a flat market, or in an up market. And in fact, we just looked at two yesterday. Look at the two trades we put on yesterday. It's not like you have to wait long to see these things. We do them every day. What is this? Oh, it's the wrong. Come on, up. Ah. There we go. So in yesterday's post, we had two trade ideas. So let's talk about this. Here's Sonic. So yesterday, morning, Sonic was here. It was just around the $25 line. All right, and it's had a bit of an adventure since then, but basically it hasn't moved much. What's the spread we set up based on Sonic being at 25 at the time? I said, here's what we're going to do. We're going to sell 10 2250 puts for $12.50. Now, 2250 is 10% below where Sonic was yesterday. So unless Sonic drops 10%, those expire worthless. If Sonic drops 10%, I'm forced to buy Sonic for $22.50. I don't have a problem with that. I want to own Sonic at a 10% discount to today's price. I think they're worth it. I wouldn't do it if I didn't think they were worth it. The whole point of selling a put is you sell a put in something that you would want to buy if it gets cheaper. So in other words, I want to buy a Range Rover, and it's $80,000 list price. I already have a car. My daughter needs a car. I might give her my car, but only if I had a reason to get rid of my car. Otherwise, I'll just buy her a regular car. So I kind of would like to get a Range Rover, but they're $80,000. I'm like, it's like I'm not too psyched to spend $80,000 on a Range Rover. But if I can get it for 20% off, I get pretty interested. So now, how 20% is $64,000. No, wait, 80, 16, yeah, $64,000. So if I can get it for $64,000, I'm suddenly very motivated to get the Range Rover, right? It's a whole different thing. I can get it for $80,000 now. Any idiot can buy it for $80,000. But what if I could get it for $64,000? Now I'm excited. Because frankly, if I buy it for $64,000, I could drive it for 3 years and sell it for $50,000. So I mean that's a no-brainer. It's only going to cost me $15,000 to drive it for 3 years. So how do I get a Range Rover for $64,000? Well, I can't. Just like I can't get Sonic for $22.50, can I? But what I can do is I can go to the Range Rover dealer and say, hey, I tell you what, you're worried you might get stuck with this car. You pay me $4,000. And I promise that no matter how low Range Rover gets, I'll give you $70,000 for it. So what happens to me? So now I'm getting $4,000. This is me selling the put to the dealer, right? I take a put on his Range Rover at $70,000. So he's now guaranteed that he will at least get $70,000 for it, even if it sits on his lot for a year or whatever and doesn't sell. And so he's like, my worst case is now I sell to Phil for $70,000. His list price maybe his cost was $65,000, whatever. So it works out for him. He would break even. His attitude is, well, at least I'll break even on it because I sell it to Phil for effectively $66,000. From my point of view, I'm either going to own a Range Rover for $66,000 or, and more likely, because I don't really think the Range Rover is worth less than $80,000, and I don't see why it would go on sale that cheap. But if not, then I got $4,000, and I can take that $4,000, give it to my daughter, and tell her to go get a used car. Problem solved, right? And what did I do? All I did was promise to buy a Range Rover on sale. That's all you're doing. I hope that wasn't more complicated than the option. But I'm trying to put an example in a real life thing. I know I want a Range Rover for sure, and I know for sure I want to own Sonic long term at $22.50. And it's not $22.50; it's $22.50 minus $125, so it's $21.25 is my net entry in this particular case. But since I'm going to spend this $125 immediately, I'm really going to end up owning it for $22.50. Now, second part of my trade. So that's how I got my $125. Now, second part of my trade, I'm not greedy. Sonic's at $25 now. Rather than saying I need Sonic to go up to make money, I'm saying, you know what? If it flatlines, I'll make money. Because I can sell the 22, I can buy the 22.50, 25 bull call spread for 350 minus 220 is 130 for $1.30. So I can buy this 250 spread for $1.30. Now, if I did this straight, I bought twice as many as I sold the puts. If I did that straight, my net would be practically zero. My net would be a nickel on a 250 spread that's in the money now. So again, understand my positions. And by the way, obviously, I don't know what Sonic individually is going to do. But if you have a nice diverse amount of positions that are like this, then basically you can assume that they're gonna either do well when the market does well, or they're gonna do poorly when the market does poorly. They'll probably generally kind of even out with the market. So, but of course, I'm trying to pick what I consider better values than just the average S&P stock. So in theory, I could outperform the S&P even when it doesn't do well. Which, if you look at our hedge fund, frankly, that's what we're doing. We're up about 3%, I think, for the quarter, even though the S&P is down 2%. So we're basically beating the S&P by 5% for the quarter. You know, and that's exactly why. I'm not doing anything complicated. All we're doing is saying we're going to make money unless the market goes down 10%. The only way I lose on this trade is we're in for $13.50. If the market goes down 10%, we're going to lose the $13.50 and end up owning Sonic cheaply. That's the only risk I have here. Now, obviously, it can go down 20%, and I'd be a little worse off. But if it goes down 20%, what am I going to do? I'll be down on 1,000 shares of Sonic for my net $13.50, and another loss of $2,250. So I'd be down about $3,500. So if the market drops 20%, I'm going to lose about $3,500 on. I won't lose. I'll be down $3,500 on Sonic. I still don't mind owning $20,000 worth of Sonic that's down $3,500 for the long term, because I could sell puts and calls and make the money back. I don't see this as a big downside. I'm not worried about owning Sonic because I like them long term. I don't think they're going to go out of business just because the stock market crashes. They might get cheaper, but that's got nothing. It's not their fault. It's like in 2008, there were so many companies like Sonic, or McDonald's or whatever. McDonald's is sitting there being on sale for, I forget the number, but some ridiculously low number. I don't think I have a chart for that, but no, I don't have the long-term charts up. I'm not going to do that. Anyway, whatever McDonald's was, now let's say it went to, let's say it's usually $100 and it was $50. It went down 50%. So what did McDonald's do in 2008 that caused them to go to $50? Nothing. Wasn't their fault, but they go down with the market. So you go turn around and buy it. You say, geez, there's still, did their restaurants burn? Are people going to stop eating McDonald's? No. In fact, frankly, when you have no money, more people went to McDonald's. They realized that was also our logic in buying Walmart. We were like, when Walmart went on sale in 2008, we're like, well, won't more people go to Walmart instead of less? It's like more people are going to say, oh, let's go to Walmart. They're cheaper because we got no money. And the dollar stores, those went crazy. There's logical things you can do when the market sells off. But anyway, so the point being, if the entire market sells off and Sonic drops 20%, I'm not in bad shape because I'm only down $3,500. If I bought Sonic for $22,500. So I bought 1,000 shares, and the market dropped 20%. I'd be down $4,500, not $3,500. So I'm actually going to be down less than if I just bought the stock and it dropped 20%. But anyway, the point is not that. The point is more that, though, I will absolutely, on anything less than a 10% drop in the market, I will make a profit. That's how we set up our positions. I don't need the market to go higher to make money. I need Sonic to stop going down. And frankly, it could still go down. It could go down another $1.25, and it could be at $23.75. And this trade would pay 20 times 125. This would pay back $2,500. I'd make about $1,200. I'd make 100%, which is 100%. I'd get 100% return on my cash if Sonic only drops 5% from here. So if Sonic drops 5%, I get 100% of my money back. I double my money. If Sonic drops 10%, I'm going to lose $13.50. So that's kind of my window there. So what does the hedge do? The hedge is going to pay me back the $13.50 if the market is down 10%. If the market is not down 10%, then I know for sure I'm making money on my Sonic that outweighs the small amount of money I paid for the hedge. Because the hedge is paying $10,000. I'm saying it's distributing it out. But the hedge actually pays $10,000. Just my Sonic trade alone will pay for that hedge if the market goes up. So this is why you guys have to understand, why are we hedging and what are we hedging? We're hedging good positions. We're not hedging shit. If your portfolio is full of crap positions, it is not going to help you to hedge it. If you are taking ridiculous chances and you need the market, or you need not the market, if you need your individual share to go up 10% before you make any money, then you are not in a good position. Then your hedge is stupid. You're leaving yourself a huge gap in which you don't make money. Our positions make money whether the market is down a little, flat, or up. So anything more than down a little, and our hedges kick in, and then we're covered. In fact, look at the short-term portfolio. Where is it? Oh, here it is. All right, let's refresh. All right, check. 67%. That is in 3 months. We are up 67% on our hedges. That's $67,000. Because the market has been trending down, and we've had good opportunities to make some very nice money. And this isn't even fully paying us off. This DXD spread is a $40,000 spread, and currently it's netting $14,000. So if the Dow goes, it's already at 9, it's at 9 now. So if the Dow drops a bit more, this thing will pay us another, what did I just say, 14, another $26,000. And then we'll be up $100,000 in this portfolio. And then we've got this SQQ spread, which is 15.20, and SQQ is currently at 19. It's practically all in the money. This spread is 80, so it'll pay 80 times 5. This is another $40,000 spread, and this one is currently valued at 43.6 minus 15 is 38.28. This is valued 28. So this thing has another $12,000 to gain. So I make oh damn it, I forgot. 26 here and 12 here is 38. There's another $38,000 left to gain on these hedges. So we'd be well over 100% gain in the short-term portfolio. Unfortunately, in the long-term portfolio, since the market is now turned down for the year, the long-term positions are no longer. See, they were up almost 10% at one point. They're now only up 3%. Still, 3% here is $13,000. So I got 67,000 in the one portfolio and 13,000 in the long portfolio is $80,000. So we're up $80,000 from a $600,000 start on two portfolios. That's in 3 months. And sometimes the long-term portfolio is up and sometimes the short-term portfolio is up. But between them, sometimes my hedges are paying off and sometimes my longs are paying off. So we're just approaching the point now where we get in trouble with the long-term portfolio, not real trouble, but only like a short, at the moment it could go underwater because we're finally hitting the point where the hedges have gone into the money. So what am I going to do? We're going to add a new batch of hedges if these guys go completely in the money. And we'll do something complicated because what we're going to do in the short-term portfolio, and I'm not saying to do this yet, I'm just saying here's generally the strategy, is if we're at the point where we're going to say that we need more hedges, we're going to cash these, the September 15s, and we're going to collect $43,000. $43,000 was our maximum payout at 20. So we would cash those. These guys are not in the money. They're out of the money. And we would then cover these 40 with a longer-term bull call spread that covers us for another like $80,000. So a similar trade to this one, but longer term. So now what happens is we switch to betting on a longer downturn. But then if the market bounces back in the short term, these calls expire worthless and we keep that money. So instead of being negative 3,000 like we are now, we turn that into a positive and we still have the longer term hedge. And you may need to replay that like 5 times and look at a chart. But it's like you learn by doing. You have to get into the concept of doing it. It's like playing a game of leapfrog, though. We keep moving our positions around to take advantage. And in this case, the advantage we can take is this position was never going to pay more than $40,000. Well, I mean, there's uncovered ones, but besides that. So if we can cash it for 43, we've already taken out the maximum amount of cash we could make at 20. And we're not even at 20 yet. And since we always want hedges, we just buy another long-term hedge. What did this position cost us? It only cost us $20,000 to start. So we're taking a profit of 20-something thousand off the table. We buy another $20,000 position to cover this. And that's how we manage our hedges. And that's why we're upset. That's why we're up almost 70% in our hedges. Now our longs, we don't care if the longs are up now. They're 2-year trades. If they're not up at the moment, that's not a big deal. So let's see if we have any questions so far. Chinese Plastic says, in the options opportunity portfolio, I had the January 20 short calls SQQ fill at 320 on Monday morning. Do you think I need to carry this leg of the spread, or do you feel the NASDAQ is still toppy and heading lower? I don't know. This really isn't a good forum for, just do whatever you want and then ask for help. It's not what this is for. You have some, I don't know what you mean. I had the January 20 short calls. January's gone. Do you mean the 2020s? I don't, again, talk to me in chat, because this is like, I can't really get into this whole thing now about how this goes. AG is saying, like, what to do nearing expiry when the SQQ is above 22? You don't have to do anything. If you have a covered call, you're gonna get the net of the spread. Now you have to check with your dealer whether they close them automatically or whether you're gonna have to do it. But either way, you're gonna get the net of the spread. One way or another, that's what you'll end up with. So you need to talk to your dealer about your broker. Dealer. It's like a dealer. You need to talk to your broker about what their policy is. Now, Thinkorswim, well, actually, you know what's funny? You can't get a straight answer out of them either. Thinkorswim, what they do in my experience, is they cash out your, if you have a hedge, if you have a spread that's in the money, they'll cash out both legs and just drop the net into your account. So you don't have to do anything. But I've asked them this before, and they will not promise you. They won't state that that's their policy. That's just what they do. But they don't want to get into a position where they're kind of obligated just in case something freaky happens. They don't want to have a thing where you point to on a paper and say, you're supposed to cash this out. Because sometimes things aren't so liquid. So although they don't state it, the reality is I no longer, and again, because if there are consequences, I can afford to deal with them. That's when I say something, you have to understand my perspective on it. If I lose $1,000 or $1,500 because something stupid happens, it's not gonna kill my day. And since it hasn't happened in all the years I've been doing it, the aggravation of closing it wouldn't have been worth the money I could potentially lose if something goes wrong. But what effectively happens is if I have a covered call in Thinkorswim, in other words, if I have a bull call spread or a bear put spread and it's covered and it's in the money in Thinkorswim, I don't even bother closing it out. I just let it expire and they just drop the cash into my account. There's really no reason to go through the hassle. On the other hand, though, even at expiration day, I do like to play the momentum. So if there's a swing and I think I can take advantage of it to create a better exit for myself, I do. But I don't worry about it if they expire worthless. But that's only because I understand that to be their policy, though they won't specifically state it. Can you explain how a strangle makes money? If you buy a call and buy a put at the same strike, doesn't one cancel the other out? They don't cancel each other out. I mean, let's say, for example, and we're really not getting anywhere talking about things like this, but okay. For example, if you take Apple, okay? Oh, not that kind of Apple. That kind of Apple. All right. So if you take Apple and they've got earnings, I don't know when. Let's say in May. I don't know when their earnings are probably late April. So you want to play them for earnings. So they're at 168 now. So let's say I take the 165, and if I were to buy the 650 or 630 puts and buy the $10 calls, do they cancel each other out? Well, I mean, they're betting against each other. If one goes up, the other one's going to go down. But what do you have to concentrate on? What you concentrate on is the net. I paid net $16 at 165. So what would my bet have to be? My bet would have to be that Apple moves more than $16, 10% up or down on earnings. And if that happens, I make money. Anything over a $16 move in the next month, I make money. So basically, that's what you'd be betting. I don't like that bet. I would never make that bet. I hate those bets, but that's what you're betting because you are betting against yourself. If I were going to make a bet on Apple, I would say, well, see, the thing is, I can't divorce my betting from the fundamentals. So I don't see any reason Apple would go below 150. So I would sell the 150. I would sell, not buy, because I'm not a sucker who plays at the casino. I am the casino. So I will collect money from some idiot who thinks he knows what Apple's going to do, and I will sell the 155 puts for $3. And I wouldn't do this because it's small money and it has a chance of failure. So why would I play things that have a chance of failure? But if I were going to play it, I would sell the 155 puts for $3, and I would buy, because I think that they probably will go higher, I'd buy the 170 calls for $7. So now I net the 170s for $4. So now anything over 170, and they're at 168.50 now, as long as I get over 174, I start making money. So I would do something like that if I wanted to be played. I wouldn't play against myself. You could sell both sides. You could sell the 180s because I don't think Apple's going to go up 10%. So let's say I sold them both. Even that's better. If you sell the 160s Was it the 160s? No, the 155s. If you sell the 155s for $3 and you sell the 180s for $3, so $6 or $6.50, whatever it works out to, then what happens? Then you're betting that Apple is somewhere between 186 and 149. And anything between those numbers, between 149 and 186, you make money. That's the way I like to bet. And that's called a short strangle or short straddle, one of the two. I think it's a short straddle. Now, no, I'm sorry. When it's split, it's a strangle. So in my case, it would be a short strangle. And we do play those in the butterfly portfolio, but when we play them, we're covered long term. We have long positions that cover it. We don't just naked play it, because these trades always seem like fun, but eventually they burn you. Just one bad thing when the stock goes 20% against you, and all of a sudden you're paying like 10 times what you collected. So I do not like them for that reason. And we don't play them very often. But if you want to see an earnings play, let's finish talking about the Sonics. Or whatever it was we were talking about. What were we talking about? Can't keep track. Oh, no, it wasn't SQQ. It was Tuesdays. It was Sonic. All right. This was an earnings play. I thought Sonic would go up on earnings, and therefore this play should go in the money very quickly. Well, first of all, it was already in the money. I was just betting that on earnings they would go higher and not lower. So remember what I said. We're going to make money if it's flat. We're going to make money if it's up. And we're going to make money if it only goes down a little bit. Yeah, Walgreens is right there, so I'll talk about that next. Imagine that. So anyway, let's see what happens. So it's only been a day. It's really not much of a thing. They only have the earnings today. But because they had their earnings today, some of the money would have washed out of the premium already. So let's find September, and let's see what actually happened. 2250 puts and the 2250-25 spread. So the 2250 puts have dropped down to 95 cents, and the 2250-25 spread is now, I would say $4 minus 240 is 160, right? So let's call that 160. So these are 160 is $3,200, and these are 95 is 900 is $1,000. So let's say this is now 20. So the net of this spread is now $2,200. So it's gained just about $1,000, or that's in a day. One day. So screw your stupid strangles and straddles and blah, 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 okay? It's all bullshit. This was a nice, sensible, long-term play on earnings that made $1,000, which is getting close to 100% in one day, because I happened to get it right, and it didn't get very right. Sonic's only up, Sonic's up 7 cents. Okay? What did I say? If it's flat, we make money. If it's up, we make money. If it's only down a little bit, we make money. It's hard to lose money if you set your trades up properly. It's hard to lose money if you play conservatively and be the house and sell premium to people. Don't buy it. When we buy when it was at 25, we bought the 2250 calls for $3.50. We paid $1 in premium for the calls. I don't want to pay any premium. So we sold these puts for $2.20. So what does that mean? That means I got my $1 back, and I sold an additional $1.20 in premium on this side. He's paying premium. This idiot's paying $2.20 in premium. I paid $3.50. I paid $1 in premium. They were in the money by $2.50. I paid $1 in premium. I found somebody who's much dumber than me to pay $2.20 in premium. He paid 120% more premium than I did. And then I sold to this guy also, and he paid premium also. I'm the house. I've got zero premium. I wiped out my premium, and then I sold 120 here and 125 there. Now, had I done 10 puts, I would have sold 10% of the stock's price in just premium. That's how you play. Stop trying to win in the short term, because your fallback to trying to win in the short term is losing. My fallback is owning a perfectly good stock cheaply. I either win when it's flat, I win when it's down a little bit, or I win when it's up. And if I lose, I own a good stock that I wanted to own cheaply. As opposed to this idiot, and don't be this idiot, who pays $2.20 for calls that are now worth, a day later, well, they're still worth $2.20. Actually, he didn't do so badly because Sonic went up a little bit, so he didn't do badly. I did good. Our 2250 calls made a nice gain, and of course the short puts took a quick loss also. But generally, this is all premium. He's not going to make any money at all until Sonic is at 27.20 in the end, and he can't do. From my perspective, he can't do anything to me. I've got the contract. It's too late. He sold it to me. It's now under my control. I will hold that thing until there's not a penny left of premium, and I will take that 220 and put it in my frickin' pocket, and I will have my calls. And I will have my short put money too. It's a conservative, sensible play that just so happens to make 100% a day later. Make trades like that. Don't gamble. Everybody's freaking gambling. It's driving me crazy. I'm sorry. I'm very, very stressed out about that. I can't. Everybody's like gambling on everything and trying to make all this money and looking for these plays, and it's so ridiculous. And I don't understand it. I don't know what I'm doing wrong. What am I not explaining when I lay out these trades? And it's right there. This is yesterday morning, right there. Boom. Here's the trade. Here's the logic of the trade. Here's what we're trying to do. Here's your worst case right there. I own 21.25 is my worst case. And a day later, it's up 100%. I don't know what else I can do. I can only come. I guess I can come to your house and beat you over the head and force you to make trades that are sensible. But other than that, I don't know what to do about this thing. All right, so that was that one. Now, Walgreen Boots. All right, so this one I like better, and we put it in a long-term portfolio. The problem with this one was we're very full in the options opportunity portfolio, so it wasn't worth doing, and it doesn't fit for the long-term portfolio. Otherwise, I would have done it. So what was my take on earnings? On what earnings? On Sonic, their earnings were fine. They actually they sold a bit less because they raised their prices a bit, and they made more money. I don't have a problem with that. It takes customers a while sometimes to adjust to the new prices, but they come back. McDonald's has proved that 1,000 times over, and it's basically the same customers as Sonic. McDonald's gets you to start liking McDonald's. McDonald's is very brilliant. They use their dollar menu to get you to like something and form a habit. They're like dealers. They are dealers. They're basically drug dealers. They get you to like your French fries every morning for $1. Why would you not want French fries for $1? Why would you not want chicken tenders for $1? Right? So they get you to try it. They get you to like it. They get you hooked on it, and then they take it off the dollar menu. And then it's $1.25. Now, you come into McDonald's and say, oh, man, French fries aren't on the dollar menu anymore. They're $1.25 now. Well, that's not so bad. I'll buy that. And meanwhile, you just paid them 20% more, 25% more. You're not that price sensitive. So McDonald's is really good at easing you into things. Sonic, they do the same kind of thing. They got these specials with the shakes and so on and so forth. And so you get used to having a shake every Wednesday, because it was cheap all summer long, and then they take the special off, and you still come in for your shake every Wednesday. That's how it works. Once they get you hooked, they raise the prices. They get you addicted, and then they charge more. All right. Walgreens. Speaking of drug dealers, Walgreens. I could not even understand how this thing could be this cheap. They just bought Rite Aid. They just took over 1,900 Rite Aid stores. They've got no competition in so many markets. And Boots, I guess Americans don't know what Boots is. Boots is a really, really good drugstore. If you go to Europe, Boots is everywhere. And Boots is gorgeous. It's a nice, well laid out, great place with drugs and makeup stuff and all kinds. It's like lots of stuff store, but it doesn't look like Target. It's like really kind of well organized and nice, and they've got great everything, and they've got a big pharmacy department, of course, but it's really more of a general store. But and of course, all these drugstores are moving towards that, but they've been doing it for decades now. I mean, I remember 20 years ago, I thought it was so weird that the drugstore would have like all this stuff. And now, of course, we're kind of used to it because you see all these drugstores that have all this other stuff. Because people come there a lot. Old people go to these drugstores like every other day to buy something. So now they got milk and cigarettes and candy, and that's not cigarettes. They got milk and candy and soda and things you have every day, and all kinds of little household goods, toilet paper. Because they said, well, people are in here constantly. You're in there more than the grocery store. When you get old, that's you'll be at drugstores a lot. So let's see. So what happened to Walgreens? So they had good earnings, of course, and they're up $1.50, which isn't much. It's not a big deal. What is that, like 2.5%, I guess, right? And what was the trade? I got no memory. The 65 puts for $7.50. And the 60-75 spread. So let's see. So now we've got, and it's not like I'm expecting this to make a lot of money on day one. This wasn't that kind of trade, but the 65 puts are still the same price. And again, notice they were at $65. I took the middle spread, the 60-70 spread. I'm not looking for them to go up much. And the 60-70 spread was, or is now, $13.50, and the 70s are, let's say, $7.50. So that's net 6. So the puts are the same, and the spread is net 6. And here, oh dear, it's the 60-75s. I was going to say, boy, that didn't make any money at all. Let's try that again. So the 60s are $13.50. And the 75s are 6. So now it's $7.50. There you go. So not much movement. These guys are the same price, and this spread is $7.50, and it was $6.50. Right? 6, 5. Wait. 7. $6.50, $6.50, $5.50, 13. No, $7.50. Is it the same $7.50? Oh, it hasn't changed at all. Oh well, but that's fine. Meanwhile, the bottom line though is that we paid. What did we pay? The net blah 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 of the spread is $37.50. So we paid $37.50 for the spread. That's basically $63.75 is our break even, and it's now $7.45, so we're now $7,400 in the money. So if they flatline from here and the premiums expire, we'll be up $4,000. So we don't need big moves to make money. So this spread is just what you call on track, and because it's such a long-term spread, there's been no change in the price. That's not the kind that makes money. An earnings spread is one with a shorter time frame. So Sonic was an earnings spread, and I said as much in the thing. And this one wasn't. We played it on earnings because I was worried that it would get away. I've been wanting to get Walgreens for a long time, and I thought if they had good earnings, they'd pop up and we wouldn't get a good price. But this is more long-term trade. But this is what we call this is on track. It's at $67.50. We have our put sales 65 because I seriously didn't think it was going to drop another $1 from where it was. And now all we need them to do is continue to trend up to 75 over the next 2 years, and we're going to collect $15,000. And again, it goes back to what happens if Walgreens goes down. What if it goes to 60? If it drops 10% to 60, the spread goes worthless. And again, it won't be worthless immediately. It's assuming I don't do anything. But the spread goes worthless, and then we're down $5 on the stock times 5. So $2,500 is our risk on that trade on a 10% drop. So if I hedge it with a hedge that pays me $2,500 when the NASDAQ drops, I'm going to be fine. And that's what the hedges are supposed to cover. The catastrophic drop. A little drop doesn't hurt me in this position. It would have to be a catastrophic drop for me to actually lose money on the spread. It has to be like at least a 10% drop before the spread has any real impact on my positions. And that's what the hedges are for. They're in case all your positions start going down. If some of them go down and some go up, that's just normal. That happens all the time. But if all of them go down at once, that could be a problem because it affects your buying power. And that's what you want to have a hedge for. But if you take all your trades and make nice conservative trades like this, you will make so much more money. So who else is going here? We got Wednesday. These guys I liked. I like that they got a. Oh no, I'm sorry. It said they had a 47% implied move, but it doesn't. GameStop, is that tonight or did they go already? Anybody know? Nobody? Okay. Who says Thursday then? Nobody interesting. I mean, nah, unfortunately, none of these guys are somebody I'd want to play. But we'll do, we'll do these earnings trades as it goes on. Next week we'll do some too. Oh, there's not going to be a webinar next week because I'm going to be in Florida. And the week after that, there won't be a webinar because I'm going to be in Vancouver, in Whistler, actually. I got 2 weeks of traveling I have to do. Fairly normal trading hours, but I'm not going to do the webinars because I'll be on my laptop, and especially in Vancouver because it's like 3-hour time difference too. And I'm not going to be in the mood because in order for me to be up for the Open in Vancouver, I've got to get up at I got to be up by like 3-4 a.m. just to get my day ready and whatever. So no thanks. And of course the market's closed on Friday, so we got 2 weeks with no webinars. You guys are gonna have to wait. After that, we'll get back to normal. So what else is going on? Let's see. Oh, petroleum status report. That's good to look at. This says March 16th. Refresh. Aha, magic. March 23rd. Okay. So oil inventories went up 1.6 million barrels. And let keep in mind that the refinery input is 16 million barrels a day. So this is so in a week that's going to be I don't know, 105 and then another 7, about 110, 120 million barrels a week of oil. So 1.6 million is getting like barely over. It's not even 2%. So it's just you have to realize that some of these numbers that people focus on are like they're rounding errors. So it doesn't tell you that much. Gasoline down 3.5 million barrels and distillates down 2.1. So obviously a big drawing product of 5 million barrels and a building crude of 1.6 million barrels. So net, we're down about 3.5 million barrels net, almost 4 million barrels net. But look at this number here. Every week they export more and more. Last week it was 27.56. Now it's 28.42. Another 700,000 barrels were exported last week, more than the week before. So, and the total amount of barrels that are being exported is getting close to 3 million barrels a day. It's 21 million barrels. We only produce 20 million. We're now exporting more than a full day supply of oil. That's insane. And the real insane thing is that even though we're doing it, we're still building an actual crude inventory. So that's why this whole thing is not very supportive of where we are now. And the really ridiculous thing is that the price last March was $47.30, and now it's $65.80. It's like 50. Well, let me see. It was 14, it was 18, 20. I don't know. It's like 40-something% higher. That's crazy. And gasoline's worse with gas. I'm sorry, it's not worse. Oil is worse than gas, but gas is up from 230 to 265. So that's up 35, which is about 15%. So oil's up much more than gas. And again, that goes back to poor refiner margins. Okay, because gas is only up 15%, but the thing they make gas out of is up 40%. That means the people who make the gas are not doing well, which is why they're shoving all this gas overseas. I mean, one of the reasons they get better prices overseas. You know, but we know America would be freaking out about the price of oil if the price of gasoline were going up with it, but it's not. If the price of gasoline went up 50% and was $3-something a gallon, and you were paying 20% more every time you went to the pump, you'd notice. I just filled my car. I drove my daughter up to Amherst, you know, to do a call, you know, for her for her orientation, whatever the hell you call it, campus tour, you know, that's not an orientation. Anyway, so she got accepted. She went to see the campus, and she went then and went to Holyoke. She saw that campus. And the gas was, I got there, I emptied my tank, it was 25 gallons, and up there it is about $4 a gallon. I had a $100 bill for freaking gas. I was like, son of a bitch. It's been a while since, you know, I'm in Jersey. Jersey's generally pretty cheap, although not as cheap as it used to be because they added 32 cents a gallon gas tax. But up in Massachusetts, they're already paying $4 for gas in some places. And that means California's got to be way over $4. So, you know, that's some nasty stuff. I mean, these markups are really terrible. Sri says, next week I'm going to be in Panama City Beach. Drinks are on me if you have me close by. Is that Florida? I'm going to be in Florida next week, actually. But very family-oriented trip, so I don't think I'm going to have time to go have drinks. It's Passover. Actually, I can't have drinks. It's Passover. That's why I'm going. Can't leave and go for beers. That's not. It's kind of against the whole concept of the holiday. All right. So what else is going on? See if anything's happening. Meanwhile, oh wait, how's our indexes looking? I was hoping to do some futures trading, but we're not getting there. Up, down we go again. All right. Well, you know, as we expected, though, it just keeps trailing off. So. Not much we can do about it, unfortunately. It's not a very good environment for making bets because it's just jiggling up and down so much. Same thing, though. Like I said before, below 6,500 is where you play that guy. And, oh, that was an easy one. We missed that while I was talking. It was 2,400, though. 24,000 was a good line. And oil's punching up. Gas punching up. Dollar really zipping the dollar. It's funny now. With even though there's this pressure from the dollar, we're still getting a big move up in oil. So this is that weekend push that we were expecting. I want to short the hell out of these guys. Unfortunately, it's kind of hard to short over a long weekend because on a 3-day weekend, what if there's an OPEC announcement or something happens or something blows up? You know, unfortunately, it's hard to go short on the weekend. But I really want to be short. Probably first thing Monday on oil or gas. You know, if they get if they punch up to the highs again, you know it's only just to screw you with a pump over the weekend. So it'd be a nice chance to get in short again. All right, news. That's right. We're going to look at the news. Let's see. All right, Turner speaks. Who cares? Takata. Who cares? Oh, wait. Oh, that is actually, we do care about that one. They're buying Shire. It's like, look at $50 billion. Holy crap. Wow. So Farm, and the odd thing is that Farm is doing. What is that thing we like to play in Farmer? Wait. I can't think of the name of it. Labu, Labu, Biotech. LABU is an ultra long biotech ETF. And I do like to play them when they're down in the channel. And the channel is here. This is, see the bottoms? Bottom, 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 below the bottom. So down here, they start to get, they at 70, they'd be super interesting for a long. It's a very violent moving ETF, but you can see from the Shire deal, $50 billion is, I don't know. I mean, I don't know. Well, let's see what they're up. SHPG. SHPG. So even now, that's still 20% higher than where they are now, and they're already up 13%. So you're talking about, like a 30-something% premium for these guys. I mean, that's crazy money. Oh, Restoration Hardware beat too. Yeah, so this is a huge thing. And these Japanese companies, they got to make these deals because they're going to run out of the cheap money. The cheap money train is going to end for these guys. So if they're going to buy something, they got to start pulling triggers. But it just shows you how how few things there are to buy for a good price right now because they're paying up a huge amount. So they run at Shire as a stretch. Yeah, this is a stretch. $50 billion isn't a stretch. I think only Berkshire Hathaway could, or either Berkshire Hathaway or Apple, the only two companies where $50 billion isn't a stretch. Edmunds expects March oil sales to pop. I don't see why. We had a lot of snow, and that would have probably locked in some customers, but we'll see. It does have an extra selling day. Oh, so they're saying the 3% is the extra selling day. That's where they expect 3%. I say no, though, because there were several large snowstorms that would stop people from going out and buying cars. You don't go out and buy a car in a blizzard. So they're wrong, and it'll disappoint. Realized equity volatility is the highest in 2 years. Yes, it is. It's exciting, though. I love it. GasLink, blah, blah, blah. Germany, Argentina Central Bank holds policy rates. There you go. You guys are looking for yield. You can go to Argentina and get 27.525% for your money. Unfortunately, you've got to convert it into whatever the hell they use. And I forget the name of their currency, but don't do that because they got some scary inflation there that wipes that out. CME next, Baccarat bounces. Look at this. Las Vegas reported game revenue increased 7.6% in February. Revenue on the Strip jumped 11%. That's really good. Downtown Las Vegas was up terribly. Downtown Las Vegas is sad. That's not the Strip. That's the old Las Vegas stuff. Total slots. Talk about a bad thing to play. Total slots. Game table revenues up 13%. Wowie. Off a winning percentage of 13.75%. Back, see, be the house. 13.57 winning percentage. That is amazing. Baccarat revenue. So their revenue, their 13% was this much money. So we multiply it by 6. So it's $2.5 billion was bet, and they took in 400 million of it. They kept. Baccarat revenue soared 80%. Holy cow! Wow. Those Baccarat people are serious gamblers, bookies took in more than, and that's actually a low percentage gain. So surprisingly, if that made up a big piece of it, it's not though. It isn't though because he's talking about $2.4 million here. Sorry, billion. So this is only not even 10% of their total revenue is Baccarat. Still, it's a lot though for one game. Las Vegas bookies took in 10 million. So that's nothing. Oh, that's good. That's interesting stuff. So Vegas is doing well, though. They're coming back nicely. Netflix, woof, man. Netflix got a big hit. Netflix is I've been bitching about them for ages because they're not worth it. Coinbase adds in more cryptocurrencies. Chevron says Venezuela oil fields are operating normally. That's interesting. Because Venezuela is a total disaster. Actually, that's bad because that's bad for oil. So I don't know why oil is going up, because if they're operating normally, it means that one of the premises of oil being higher right now is that Venezuela's oil isn't going to stay online that long. Because if their currency is worthless, it's hard to pay people and do other stuff. Red Hat, Lionsgate. I used to like Lionsgate a lot. So nothing really market moving. Comedian Brian Allen is buying the Weather Channel. That's interesting. I wonder if he'll make it funny. British Columbia unveils rebates for LNG and potential boom to Shell's LNG counter. Oh, good for them. Okay. Why do these all say new? They don't say, like, it's weird. Maybe just because I never looked at them. Stock market's biggest losers speak volumes about Trump's tariffs. Nothing. Dropbox prices. What? I thought they already did their IPO. What is this about? Market Newsfeed Live. I don't know. I thought Dropbox already did their IPO. That's confusing me. So, new subscriber, welcome, Chipra. When you have a moment, would you be able to walk you through a trade? I can walk me through a trade that goes in the money on short puts and how you handle it. Okay. All right. Well, what do you do when a short put goes in the money? It's not complicated. It's you look. Walgreen Boots. We sold the $65 puts for $7.50. Okay. We collect $7.50 in exchange for promising to buy it for $65. If it goes in the money, let's say Walgreens drops to $55. Okay? What happens to us? We would be forced to buy the stock for $65. That's what we promised. Okay? But we keep the $7.50, so our net is $57.50, not $55. I mean, not $65. So our net is $57.50. So that means if we buy it, we're actually down $2.50. That's it on what is then a $55 stock. That's it. This is not complicated. We collect $7.50 in exchange for promising to buy the stock for $65. So effectively, that's what you've done. You've effectively bought the stock for net $52.50. I'm sorry, wait, 65. Sorry, 65 minus 57.50. Sorry, it's 57.50. You've effectively bought the stock for net 57.50. That's it. If it goes below that, you're losing money. Now, your apparent loss, if we look at the 75 puts, the 75 puts are $13. So if it drops $10 right now, you still have the premium in your puts. And effectively, they'll go to $13 from $7.50, and you'll be down like 80% on your puts if Walgreens dropped to $55. So what? You're not really down $13. You're not down 80%. All you're going to be down is $2.50 if you take the assignment. As long as you really want to buy the stock that you sell puts on, you won't panic out of it. The way people lose their shirts is they sell puts on stocks they don't really want to own, and then when it goes against them and the put's down 50, 60%, they take the loss. And now you don't own the stock, and you took a loss for no reason. Okay, when you sell a put, you are promising to buy a stock for a certain price, and you're getting paid to make that promise. Don't welch. and don't plan on welching. If you don't really want to buy it, if it doesn't comfortably fit in your portfolio at that price, at that amount, don't play it. Frankly, you should never be selling puts on a stock that you aren't willing to double down if it gets much cheaper. So if this went to $40, we would be netting in for $52.50. I'm sorry, $57.50, and then at 40 we could double down, and then our average would be $17.50, about $48.49, about $49. So if I'm going to promise to buy 1,000 shares of Walgreens for $65, I better be wanting to own 2,000 shares at $49. And if I don't, I shouldn't be playing. Because that's how that's my attitude about this, is I would absolutely double down on this thing at $40, no question. And even though my average would be $47.50. Now, what if I owned Walgreens for $47.50? What would I do? So now I have 2,000 shares of Walgreens for $47.50, and Walgreens is at 40. So what would I do? I would sell the $40 calls, and it's hard to say what they would really be priced at, but currently the at-the-money calls are $8. So let's say I sold them for $5. That would immediately reduce my basis from $47.50 to $42.50. And then I could sell some more puts, and if I sell some puts for like $4 or $3, that's going to bring my basis back under $40. So now I have 2,000 shares of Walgreens for not much more than I would have bought 1,000 shares of Walgreens for today's price. And if I don't want that, I have no business playing Walgreens. And you've got to think about every stock you buy like that. Why on earth would you be in a stock that you wouldn't be thrilled to have twice as much for at half the price? Or even at 2/3 the price? Everything you get into should be like that. If you want it, you better plan on doubling down if it drops 50%. And then you'll end up with 2 times the amount at 75% of the current price. So how much would you spend? You'd spend 150% of what you're pledging today, net, if you double down when the stock drops 50%. And as long as you're comfortable with that, then you're not going to get in trouble when the market drops and when there's a panic or anything else. But if that gets you over your head, don't play the stock. Alistair says, Vancouver, $5.85 a gallon for regular. Well, U.S., are you kidding me? In real money, it's $5.85? Wow. Well, I'm not driving, so I don't really care. That's crazy. That is a lot of money. Listening to you for the last 2 weeks in the car, safe travels. How do you listen to this in the car? Really? Like you can log into the car and do this? That's cool. I had no idea that happens. Anyway, thanks. Every time the futures take a big drop, do you automatically do a 5% calculation? Do you maintain your strong and weak lines from your terms? Blah, blah, blah. Okay. There are overriding lines that do not get recalculated unless we revalue the market. Now, in this particular case, as we last did our lines about a year ago, given the tax changes and given the corporate, the repatriation of corporate money and so on and so forth, we're generally using the 10% lines as our baselines, not the original must-hold lines. We've given the market a 10% bounce. We said fairly, we think everything should be about 10% higher now going into next year. We haven't officially redrawn those as the must-hold lines, but that's where we are. Other than that, though, we don't redraw things. We only redraw things when we decide that the fair value of the market needs to be changed. And other than saying plus 10% from where we were last year, we don't see any reason to change it. And the S&P base was 2,200, so right about 2,400 is where we think the S&P should be right now. So anything over 2,400 we think is extra. Those are our key lines that we work on. Now, that doesn't mean, though, that we don't use interim lines. So like today, we were talking about, let's see, where is that? Home. Here you go. So today, we were looking at the NASDAQ. So this is our 25% line. This hasn't changed for years. It's the same line. So in the long term, these are the indicators we're using. But in the short run, so here we say we fell from 68.50 to 65, let's say. So that's a 350 point bounce. That means, I'm sorry, it's a 350 point drop. And we can calculate over this period, the same 5% rule says there should be a 20% bounce of 70 points. That's a weak bounce. So what you're seeing right now is a weak bounce. And another 70 points. So at 66.40, which is basically back to this line again, the same 66.50 line. And by the way, since we know the NASDAQ moves in 25 units, it likes to move in 25 units, we would have rounded up to 65.75. So really it would be 65.75 and 66.50 is the weak and strong bounce line. So right now we're at the weak bounce line. And wait, the market turned all the way back up again? Jesus. No. Why? Oh, silly me. I'm sorry. That's a frozen chart. I'm used to these things being dynamic. Anyway, so that's a weak bounce line. So then failing that is bearish, which obviously we're down back here now. That's how we look at these lines. So you can calculate it. And the way you look at it when you calculate that is you have to get the weak bounce in the same period of time that you failed. So this one took a day, and that means you have 1 day to make the weak bounce line. If you fail that, then it's going to head lower most likely. Okay, in 2 days, in 2 sessions, you have to make a strong bounce line or you're back in the same downtrend. And why is that? Because this then affects how the 50-day moving average will be drawn. So you know what you're doing is you're basically looking at what's going to happen to the 50-day moving average. And if you get this weak bounce, it's going to pull the 50-day lower. And the longer it takes, the more influence down it's going to have on the 50-day moving average. And if you get a strong bounce, it mitigates the effect somewhat by half, obviously, of the pull down. But still, it's 2 days, so now you've doubled the time. So you're getting the same curve down, but it hasn't increased. If you fail, you have a sharper curve down, and now it's getting worse. Now your situation on the chart is going to be getting worse. That's where these calculations are from. You know, we were basically pre-drawing the chart or predicting what's going to happen to the charts, and that's going to then influence the TA people, and then the TA people in turn will influence what the market does next. Was that the question? Wait, I forgot. Okay, so do we automatically? So no, we don't automatically, but in each segment, whenever we see significant support and resistances, we then will recalculate based on those lines, and then we can determine what the interim strong and weak bounces will be. It doesn't change the main lines, but it does change, like for this 3-4 day period, we know what we're looking for. So tomorrow, getting back to 66.50 is going to be the goal. If they can get, well, they aren't though. They're all the way down. They're all the way down. I keep thinking it's there. So now we're back at 65. So really, at this point, they're just struggling to hold 65. But that was predicted by failing here. Oh wait, we can look at this chart redrawn. Hang on, let's get an hourly chart up. All right, so you see what happened here is they got to the 65.75, right? Fail, right? So every time it failed at that weak bounce line. So that's the funny thing is you can predict these moves because it failed at the weak bounce line. If it got over the weak bounce line, that would have been a good sign. It didn't. That's a bad sign. Now it's down to testing 65. It is most likely, since it failed the weak bounces, it's most likely consolidating for a move lower. And where is it going to go down from here? It's going to go 75 points below this. I'll tell you right now. It's going to go 75 points below this, which is going to be 64.25 is going to be the next stop. And look, we tested it over here. So we're consolidating right between these two lines, which are predictable lines, right? And below this, when this breaks, and it's probably going to break, we're going to go all the way down to 63.50. So that's ugly. Now, knowing that, we know that we're going to go 2 deviations down on the NASDAQ, on the S&P too. So it's the same thing. We can make the same calculation from, except it's hard to see the exact, 5-minute chart. Hang on. Aha. So we're failing here at 2640. We're going to call, well, no, it isn't really. It's 2630. We're coming down to the 2600 line. So call this 25 points, really. So that means it's not going to be exciting. It's going to be like 5-point moves, but we're going to move. So on the S&P, although we're not there yet, we're probably going to come back to 2600. Then we're going to go to 2605, and 2590 is going to get tested again. So that's our goal for the S&P. Is going to be 2590, and on the NASDAQ it'll be whatever I just said. It'll be 150, 6350, all the way down to 6350 on the NASDAQ. So that's what you want to look for tomorrow. And that means below the 6,500 line is a great short, because 150 points on the NASDAQ at 20 bucks a point is a $3,000 drop. So let's say you go in here and you set your stop at 65.05. You get in here when it goes below 6,500 even. You put a stop 5 points up. 5 points up is going to cost you 100 bucks. So every time you get it wrong, every time you're below and you get it wrong, 1 time, 2 times, actually, I'm sorry, no, it's 1 time. And this went so fast I wouldn't count it. So 1 time here, go below. Actually, here you should have stopped out. You should have taken some money there. You go below and it fails and you lose 100 bucks. So here you would have been net a little bit ahead if you played it right. But the trick is to just keep being in the right place, and eventually you'll get a really good drop. And just be aware though that when you get to 75 points down, when you're down at 64.25. I can't do math. When you get to 64.25, it's almost certainly going to be bouncy. Okay, right here, just like that. It's when you get back here, it's going to be a very bouncy line. So you might want to just take the profits, let it bounce, and then see what happens. But our ultimate goal is going to be 63.50 here. But what you can do when you get down to a line like that is you take the profit and then wait until you get a chance to get back in, and then do it again. You make a lot more money that way than if you just sit on it and hold it. What do I think of Comcast? I like Comcast. I don't think they're cheap right now, though. They're not on my radar, so I doubt they're cheap. CMCSA, right? No, they are actually cheap. They fell off a lot, didn't they? Look, I like them. I like them because they're a good service. I mean, it's not a good. They suck, but I mean, they're a good service, as in a good cable service with lots of subscribers. They're not really getting eaten up or anything like that as far as it goes. But everybody's worried about people cutting the cords and things like that. But the funny thing is, when you cut the cord, you're still going to end up using Comcast for their Wi-Fi. So people using AT&T and stuff. That's I prefer to play AT&T. Let's put it that way, because they have their own dish network, and they've got their own wireless systems. Plus they've got the phones. Plus they've got the LTEs and everything like that. So I prefer to play the phone companies that have the large offerings. My favorite is Frontier, but nobody else likes them. But FTR, I think, is going to be a really major move down the road. I think people have drastically underpriced this stock. So we'll see. But right now they're at 728, and I think that they should easily be probably around 1250. Would easily be 1250. So I like them a lot. We have a big position in them. I like that a lot better. How do you deal with catastrophic loss on the put side due to accounting scandal? For example, exercising would exhaust all your cap. You don't exercise them. You either roll it, or if it's untenable, you take the loss, and hopefully it's not so terrible. You should not exhaust all your capital in one stock on the small portfolio. I see. Well, you're saying, okay, so you're saying if it happened and somebody went to zero, like in the options opportunity portfolio, it honestly doesn't really happen that way. These scandals they don't wipe you out tomorrow kind of thing. Even like Shell, when they had their thing or not Shell, BP, or had their thing in the Gulf of Mexico, and even when a mine collapsed on somebody, even when Sony has the laptops exploding and things like that. No one thing really. Samsung had their phone thing. It's very hard unless you pick some stupid stock. We're not playing biotechs and promising to buy like some biotech that has one drug that could get turned down. It's not like that. There's very, very few times that you're going to get a move of more than 20% down in a day on a stock. And you just got to be able to sit there and pivot and decide what you're going to do and either get out of it or ride something out. But it's obviously a catastrophic loss is a catastrophic loss. You can take a big hit, but I don't think we really play too many things that have that kind of exposure. Like I said, even if you sold 10 of the WB, well, first of all, that would be an inappropriate trade for the short-term portfolio, so we wouldn't do it. But even in the short-term portfolio, if you sold 10 of these puts, the 65 puts for $7, you're netting in for $57.50. So what happens? You have $57,500 entry point. That would suck if it went to zero, but realistically, if it goes to 40, which is still down an incredible amount, but if it suddenly goes to 40 on you, you're on the hook for $1,750 or $17,500. That's a big hit in the $100,000 portfolio, but it's not going to wipe you out. And obviously, it doesn't happen very often. It's an incredibly rare thing. So just like anything, that's like saying don't go to a baseball game because if you sit at a baseball game, you could get hit by a ball and be knocked unconscious and go into a coma. Anything could happen. Bad things can always happen. You can't play your life that way. Otherwise, don't play the stock market. Don't pick companies that have the likelihood of having a scandal. Don't play crappy companies and gamble on things. I'd say we sold some puts in Alaskan Airlines, right? What if they had a catastrophic failure and they blamed the management and said it was all their fault and so on and so forth? And they said this company is going to be fined $10 billion and wipes them out. I guess it could happen, but I can't not play a good stock just because something might happen. So, you just try to do your best and hope that over time your gains are going to outweigh the potential losses. And we took some hits in the previous options opportunity portfolio. We ended up being up about, I think we were up 250% in 3 years. But we certainly had some losers in there. Things did go wrong, but they were wiped out or overwhelmed by the things that went right. And so you just have to hope that happens. If it doesn't, you take your loss, you reorganize, and try to come back. And 1020 says, yep, I download the GoToMeeting on the smartphones, Bluetooth, and it's like a phone call. Very cool. Wow. That is interesting. Okay. What about the S&P? Tom says, what about the S&P? It's an index. It has 500 stocks, and they're generally pretty big. Phil, what's your take on ABX? With all that's going on, why isn't there a flight to safety of gold? Why no list on ABX? I don't. Gold is really out of favor, and I think really the money that would be going to gold is going to like cryptocurrencies. I think that's a big thing. It's the same concept. It's an alternate currency concept, and you have to think like rich people think. And rich people think of their money as a big pile, right? And they're going to allocate it out to things. So they're going to allocate this much money to U.S. stocks, this much money to houses, this much money to real estate, this much money to commodities, this much money to foreign country stocks. Rich people take percentages and do this, and they'll keep some percentage of their money in yen and some percentage in euros and some percentage in dollars. They're always moving and shifting and trying to diversify their holdings out. So when you look at gold and you look at cryptocurrencies, they're generally promising the same thing. They're this alternative store of wealth. And I think that a lot of the people who would have normally been playing gold on the same logic that the dollar is being devalued and you need something stable and blah, 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 a lot of that money went from gold, or would have gone to gold, has gone into cryptocurrencies. And that's been keeping the price of gold down, even though other things are going to hell. So anyway, gold is going up a little bit, but it's not really making any real progress. Why no list on ABX? I have no freaking idea. I think, we have to let their earnings speak for themselves. But ABX has a lot of problems. ABX has, they had a mining thing that was poisoning the water in some place. They've got tax people after them in foreign countries and trying to, make money taxing the miners. They've got environmental concerns preventing them from opening up mines. There's a lot of stuff going on with ABX. It's been an abnormal run of bad luck for them more than anything else. Just a lot of little incidents that, all of them are things that happen to any miner, but several of them happened at once to ABX. But it doesn't impact them long term. Long term, the bottom line is they still have 100 million ounces of gold sitting in the ground. And that gold is worth $1,000 an ounce, or $1,350 an ounce, and $1,350 times 100 million is 1,350 billion. Sounds like a lot. 100 million times 1,000 is 100 billion. Okay, yeah, that's 1.3. It's about $130 billion worth of gold. So let's say they got $130 billion worth of gold in the ground. Now, that it costs them money to extract it. So that minus the extraction cost, which would probably be about, let's say $800 an ounce, let's say $800 an ounce. So the net of that would be $55 billion of gold in the ground that they could profitably sell. All right, so then ABX's current market cap, but that's over time. So ABX's current market cap is $14 billion. So they're a $14 billion company sitting on $50 billion that they will eventually be able to pull out in profits. But divide that by 20 years, and it's $2 billion a year. So they're really trading at about 7 times earnings. In fact, the PE right now says 10 times earnings. So that makes perfect sense. Now, why you wouldn't want a company, though, that has a 20-year reserve that they're going to make 10 times earnings for the next 20 years is beyond me. I don't understand that. So I'm perfectly happy to own a ton of ABX for the long term, because they're going to keep making money. You can sell options and calls and puts against it to make money. And if gold ever goes to $2,000 an ounce, it's all profit for them. So it's also a great hedge against inflation. I don't see any reason not to be in them. I don't understand how you calculate the NQ6350. Oh, well, it was in today's post. So go to the morning post and look at the lines. And all we did is extrapolate the lines going down instead of up. So the moves were 75-point moves from 6,500. So 2 75-point moves. The week drop would be 75 points below 6,500. The stronger drop would be down to 6,350. So I think the stronger drop is going to get tested the way things look right now. Disney is very interesting. In fact, we were just talking about adding it to the hedge fund, and we did just add it to the butterfly portfolio. And yes, we will add it to other portfolios as well. I like Disney. Again, this is, any company that invests their money gets punished. Disney invested a lot of money. They're building the new park in Hong Kong. They're building the new Star Wars studios and things like that. They're doing a lot of refreshing moves, investing a lot of capital, and of course, investors have zero patience for that, so they keep trading down to the bottom of their channel. So I like them here. I would love them at 90. This is where we bought them last year, is when they were at 90. I said, that is ridiculous. And we got heavily into them. And when it got to 114, we sold it. Because I said, that's ridiculous, because they're a $100 stock. So they're only attractive now compared to where they were. Long term, easily 120 or whatever. But when we were playing Disney, we had, I think, the 90-110 spread when it was down here. And so when it plowed over it, we took the money and ran. So I would like to, again, have the 90-110 spread. I'm not looking to, I do think that they're going to be good for 120 in 2 years. But again, I'm not going to jump in and be the first one to buy it. If they crack over 100, I'll say, okay, we got to get it. And like I said, I already did in the butterfly, because in the butterfly portfolio, we don't care if they go up, down, or sideways. We make our money selling calls and puts to other people. But I definitely do like Disney. It's just I think it could get a little bit lower, and I'm hoping the market pulls back a little bit more. Okay, TSAB says, first Wednesday with me in a while. Busy generating cash flow with other businesses. Can you discuss how investors can get involved in your fund I've heard about? Oh, just contact Greg for the hedge fund. Just contact Greg at, he's the administrator at philstockworld.com, and he will be able to tell you about what we've got. All right, so we have the hedge fund, and we also have PSW Investments, which is like a venture capital arm where we invest in small companies and such. So we have two different things that we have going right now. PSW Investments actually owns the hedge fund, so that's fun. Can you review your outlook and position on Whirlpool? Yeah, Whirlpool got amazingly cheap, which means, in other words, we were wrong with our entry. But I don't understand that, because we actually have a specific tariff on washing machines, and for some reason they can't turn it around. So we bought them when they were down in the 150s. So it's when we got in, I guess we probably got in about 160 when we got in. So now it's a little bit down at 150. I'm not particularly worried about it. I think it's a good deal. If you look at their numbers, I mean, I guess probably the concern is the cost of steel rising and so on and so forth. But they had a bad year here, and if you want to figure out the reason for that, it's because what did they do wrong? They did something wrong. Where'd the money go? Wait a minute. Oh, they had this is income tax expense, probably from repatriating money. They got a big hit on taxes, so that then gives a false impression of how they're doing. I mean, and of course we got to wait for Q1 earnings to see what's actually happening. I knew there's something weird about their thing. Yes, they took a big tax hit, most likely though from repatriating cash overseas. They've got a ton of cash overseas. Estimates are they're going to earn $15 a share, and a share is $1.50. It's $150. So that's a PE of 10. Yet, based on the tax situation from last year, their PE shows at 32. And I don't see any reason they're not going to make their money. There's nothing wrong with Whirlpool. So it's a ridiculously underpriced thing right now, and we'll probably be expanding our position on it. As a new trade on Whirlpool, what would I do? In fact, let's do that. Let's add that to the long-term portfolio, but I'll figure out the exact trade later. We go to 2020. So they're 150 now. I think 150 is silly, but just because I think it's silly doesn't mean I'm not going to do this. Because look, if the 150 puts can be sold for like $22, right? Look at these 135s, $15.50. $15.50 for the 135 puts. That's you're netting in for $120. It's 150 now. That's 20% below the current price. So yes, I want that. I would sell those. And let's say you sell, now realistically, you don't want to sell too many. It's expensive stock, right? But let's say we sell 5 in the long-term portfolio. That obligates us to buy 500 shares at 130, at 135, or net 120. And that would be $60,000. That's no problem in the long-term portfolio. We have $1 million of buying power. And that's ordinary margin. The reality is we have a lot more buying power than that. But anyway, so no problem selling 5 of those. If we sell 5 of those, $1,550, we collect $7,500. And then as a play, I'd be kind of aggressive, but again, it's about not paying premium. So you want to look for where you can get a reasonable price. And so I could take the, I look at it and say, look, the 130 calls are 30, $34, let's say. It's hard to say exactly. Let's say $34, somewhere between 33 and 36. So now let's say 35. So let's say 35 of these guys. And now what can I sell? So I got the 130s. And so if I look at the 160s, I can sell those for 20. So that gives me a net of $15 on the $30 spread, on the 130, 160 bull call spread. My net is $15, 35 and 20, right? So if I do 10 of those for $15,000 and I sell 5 of the puts, of the 135 puts for $7,500, now I'm netting in for $7,500 in cash on a $30,000 spread. So I can make 300% profit, make $22,000 blah 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 $500. So I can make a 300% profit if Whirlpool goes to 170. I'm sorry, not 170, 160. It only has to go to 160. Meanwhile, I'm $20 in the money already, $20,000 in the money already on the spread that I'm paying $7,500 for. Now, once Whirlpool does rebound a little bit, I can then sell some calls, like right now, even the May 160 calls right now are $3. So if I sell 3 of those for $1,000, I'm using 60 or 50. I'm using 50 of my 660 days. So that means I'm going to have 10, 11 opportunities to make $1,000 selling short calls. So now the spread, I'm spending $7,200 on the spread, but I'm going to be able to collect $10,000 back over 2 years just selling calls. So that's going to drop my net basis down below 0. And meanwhile, I've got the 130 calls. So again, it goes back to the same thing. Nice conservative play that's going to make 300 to 400 or whatever % over 2 years. And my worst case scenario is what? I own Whirlpool for 135. That's my worst case scenario. And that's a 10% discount to where it is now. My absolutely worst case scenario is having a 10% discount on Whirlpool on 500 shares. That's how you play it. I don't need to be aggressive. I don't need to have an incredible play, because it's going to, if I can take every $7,500 I have now and turn it into $20,000 in 2 years, why do I need to be more aggressive than that? Why do I need to take risks? I don't. All right. Now, I don't know if we're going to go for this right away, but that's generally the trade I'd like to make in long-term portfolio. I think it could be a little bit weaker or whatever. I'm not sure it's going to stay up. All right. So now we got to gonna wrap this thing up now. So what do we got? Last one is May says, "Hi Phil, got in late. If you've covered your hedges, but I should get more. But should I get more or wait if you expect a W bounce or a quick flush down?" Okay, what do we expect in hedging? Yeah, I haven't actually come up with a new hedge because we got all sidetracked on stuff. But I think we're going down lower, and based on that, I think that it'll be. Look, we have to see if it gets confirmed. But if you're not hedged, I strongly advise still using like the SQQ hedge that we had. So yeah, let's take that seriously. You better talk about that right now. I think we're going lower. I think the Nasdaq's going significantly lower. There's just too many different things going wrong that are going to make people look at these NASDAQ companies and revalue these ridiculous valuations that they have. Oh, by the way, see, look, we're getting rejected at 90 or at 89.80, in fact. That's going to help hold the market up, though, if the dollar starts falling back down. It's also going to take the Nikkei down, though, so that's kind of fun, still a fun put. What was I going to say? Oh, yeah. So I still like the SQQs. A similar trade to what we had. If you don't have the one that we already put up earlier in the week, or from last Friday, actually, we think that the we're going to certainly be over 20. And so we can go with the 20s are selling for $2 or $2.10 in May. So now I look down and say, well, where can I go? Okay, so now for $4, I can get the 16s. So this particular trade, the May SQQ May 1620 bull call spread is, let's say 390 minus 210 is 180. So it's $1.80 for the $4 spread. That's going to make 100% for you as a hedge. If the NASDAQ barely goes lower, the only way this loses money is if the NASDAQ goes significantly higher. And supposedly, if you're protecting your positions, that should make you happy if the NASDAQ goes higher. But then you want to mitigate that by selling a put if you can. It's not, it's not, you don't have to, but it's nice to, because making 200% is nice, but you can turn it into a proper hedge by now promising to buy something. So let's say you want to hedge $10,000 and you then put down $10,000. That's going to be 50 of those contracts. No, 50, wait, 500 times. Why am I not being able to do this? If you do 10, it pays $4,000, so 2,000 profit. So 50, yeah, you have to do 50 contracts, that's right. So let's say you do 50 of these for $10,000, and they're going to pay $20,000 at 20. All right, and it's not 10,000, it's less, it's, it's, what would we say, 180, so it's going to be $9,000, and they would pay $11,000 back. They pay $11,000 profit back, pay $20,000 total. If you had 50, correct. So if you did 50 of those, and now let's say you want to mitigate, of the 9,000, you want to mitigate half the cost. Now you just got to find something you want to buy. So that takes us back to, and again, Whirlpool's expensive, so it depends on your portfolio. But for Whirlpool, all you have to do is sell four. This is 11 and this is 14. So let's call this 1250. So if you sell 4 of these contracts for 1250, that's $5,000. So you're promising to buy 400 shares of Whirlpool for $125, and you get $5,000. Doesn't have to be Whirlpool. It can be anything you really want to buy. But the point is that would then drop your basis on that spread to $4,000, and you're going to get $20,000 back. So now you're going to get 5 times your money back if the NASDAQ drops a little bit more. If it doesn't drop a little bit more, you're hoping Whirlpool stays up, and your cost of insurance then becomes the net $4,000 you put into the spread. You obviously, if the NASDAQ shapes up and looks good, you can close it early, take your cash off the table, then you only end up with the short puts on Whirlpool. You can do the same thing with Apple. Apple is currently 166. You can sell the 140 puts on Apple. That's 20% out of the money, basically for the same amount. Or certainly you can sell the 145 puts for the same amount. What do we talked about IMAX, actually those same IMAXs that we talked about before. Now IMAX is a much cheaper stock, but if you sell the $20 puts in IMAX, and those are just about $4 or $380, you're gonna get $3,800 selling those if you sell 10, and your obligation there is to own 1,000 shares of IMAX. It's got to be something you actually want to own to do an offset, but that's how you can reduce the cost of your spread. And the best thing is to obviously pick something that's also in the NASDAQ, so that it would theoretically, if the NASDAQ goes up, it's not going to go down most likely. All other things being equal, any individual stock can do whatever. But that's how you construct a hedge. There's a lot of ways you can do it, and it depends on what you think you need in your portfolio. What's going to fit? What do you want to own if the market crashes? All right, so now we're done officially. And May, one more question. Now, if you come late, you really shouldn't make me stay late. That's not fair. Oh, thanks for the birthday wish. Random person whose name didn't show up. That's weird. Okay. I'm still holding the July TZA calls. They are a little bit profitable. I don't know whether to close them or reload for a bounce up. If you just have the calls naked, I would either cover them or I would cash some out. But we're going, again, I think we're going to go down significantly next week. So unless you're extremely well hedged already, I would do it. All right. Josh, sorry, it's secret. On the SQQ strikes, what did we say they were? What strikes do we pick on SQQ? All right, let's see. SQQQ, what did we just say? Was it 1620, right? Yes, it was. It was a May 1620 bull call spread. That was net 180. There you go. That was the play. And then offset that with whatever it is you feel like you want to buy if the thing goes down. All right. So thank you, everybody. I'm going to have a very happy birthday tomorrow. I'm heading down to Florida with the kids, spring break and all that. And you guys, I'll see you in 2 more weeks, okay? Well, I'll see you in chat. But we'll do this again in not 2 weeks, whatever. Not next week, not the week after that. So whatever the week of the 15th is, I guess, is the one we'll be back on for another webinar. All right? Take care, everybody.